Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. Most of you are familiar with our chart books by now. This is a new one in the series. This one is on US interest rates. Other chart books we are publishing on a regular basis on US inflation, the equity markets, business cycle, the Fed. And as you are aware, Nick Reese is preparing them. I encourage everybody, especially on this one, to listen to Nick's as well. I say especially on this one is because whenever we introduce a new chart book, Nick goes into far more depth and explains more background. And so for those of you who like to dive really deep, I encourage you to look at his recording as well. Now, I will do what I usually do. I'll give my own spin to things. And just as a reminder, Nick is at least trying to be more dry into the facts, and I do more in between the line interpretation, different styles. And for some of you, you may appreciate one approach more than the other one. If you do have the time and passion to listen to both of these, I would very much encourage you to do so. You also see at the bottom in blue and quote-unquote analysis. That's Nick's short analysis. For those of you who want to have it, and then obviously the charts speak for themselves. There is a downloadable PDF. Sometimes we get feedback you cannot in the video see everything clearly. Please go to merkinvestments.com/research to download the PDF to study this in more detail. So now let's focus on the substance here. On interest rates, U.S. interest rates foremost. We touch a little bit on others, but foremost U.S. interest rates. And so one of the things we like to do on this chart here that you see in front of you is how is it evolving? What sort of rate hikes are being priced in for the current year and for the next year? And so this, if you go through the current state here in late August, this reflects the interest rates hikes we've had already, and then what we're going to have next year. And so currently, at the end of 2019, this says will be 1.26% higher than at the beginning of 2018. And since these days rate hikes appear to be just 0.25%, this kind of implies that we have a total of 5 rate hikes in those 2 years. My own take has been that that is being underpriced in the market. I would not be surprised if we have more. If we have 6, 7, potentially even 8. 8 might be premature at this stage to say, significantly premature. But as you can see here, as you move along, the rate hike expectations do change. When you tend to have a risk-off period in the market, then those expectations do come down. And one of the reasons we do these chart books is to take the bigger perspective and sometimes take a step back to see, well, hey, where have we come from, where we're heading to. And as I'm recording this, markets have ticked up again a little bit in these rate hike expectations. And so whenever there's a little scare somewhere, a tweet by the president that a scare on trade or whatever it may be, these expectations come down, and it's helpful to kind of create your own view of where do you think things might be heading in. The reason all of this is relevant is, of course, that on the one hand, you can take direct positions on interest rates. We can help you do that here at Merk Investments. Reach out to us if that's what you want to do. But it might be relevant if you have a mortgage. It's relevant for other asset prices. My take is that risk assets in general reflect the discounted value of future cash flows. And when that discount factor is increasing, and interest rates are a key component in that, although some argue longer-term rates are more relevant in that, interest rates are a key component in that, then the discounting is greater, which means shorter-term cash flows are more relevant. And in plain English, this means when interest rates are higher, it tends to be higher volatility in the equity markets. All else equal, that would warrant low equity prices. We never have everything else equal, though, because usually there's a reason we hike rates. It's because the economy might be booming, earnings are good, as we have right now, and so of course that can be the stronger force. And so we look at this from several different points of views. Here we have a chart of what the rate hike expectations are in 2 years, meaning what does the market think where rates will be in 2 years from now. And one of the things you see is you see a bit of a flattening out here we have of late. And so and this is all in line with this thing that we are at this very accommodative level, And at some point, we'll be at the quote-unquote neutral level. And the neutral level is often perceived to be 1 percentage point above the inflation rate in that sort of order of magnitude. And so the market seems to think, oh, everything is going to be dandy, and we have to come away what is still considered to be highly accommodative, stimulative, right? I mean, even though we've had several rate hikes now, we are still in a mode that is stimulative to economic growth. Just think about that. We are near full employment. We have a fiscal stimulus in place, and we have a Fed that's pushing from behind to keep accelerating this economy. And the market is pricing in that, okay, at some point we'll take the foot off the accelerator. The market is not pricing in that maybe, just maybe, the Fed will have to push the brakes. And that, to me, is doubtful that is the case. Now, we'll see in a chart here in a moment why that may be the case, and I'll talk about that here in a second. And so here, again, another way of looking at these things, the future implied rate path here with the dotted line as to what the market is pricing in. Again, a bit of a leveling off that we see here. And a key component, and those of you who have listened to me, followed me for a while, know that this is something that I care very much about, is the whole point of raising rates is to tighten financial conditions. And when somebody like Janet Yellen used to tell us, hey, it's like watching paint dry on a wall, I've said it's a bunch of BS. The reason Janet Yellen said it is because she was spooked, in my view anyway, that financial conditions would tighten dramatically if the Fed were to engage in quantitative tightening, meaning reduce the size of the balance sheet or hike rates. And so the Fed said, hey, don't worry, don't worry, don't worry. But what has happened in practice is that as rate hikes have happened, that's kind of these black line here in the steps, financial conditions have not deteriorated. Now, what are financial conditions? They're different indices, and they're not created equal. This one here is the Chicago Fed National Financial Conditions Index, one that we happen to like more than some others. And basically, it means that credit is accessible in the market, right? And if you go back here to the financial crisis, that thing was very high. High means financial conditions are tight. And the idea is, as you kind of take the foot off the accelerator as a central banker, you're at some point going to have an impact on the market. Now, there's this broader thinking that Fed policy acts with a lag, and so you got to be a little careful because you don't quite know yet what's going to happen once you do something. But the market is suggesting, hey, these rate hikes have really not had an impact on the market. And part of it is because we are still, quote unquote, accommodative. This isn't the Fed pushing the brakes. This is the Fed slightly taking the foot off the accelerator. Here we compare the 2-year and the 10-year yields in the Treasury markets. You have the black line is the 10-year yields, and the gray line is the 2-year yield. A lot of talk has, and then the blue line is the current Fed funds rate. A lot of talk in the market has been about yield curve inversion. Yield curve inversion means that the shorter term rates are higher than the longer term rates, and one can take different types of variations in the duration. And in this case, we talk about 2-year versus 10-year. Some talk about the 2-10s curve. If you want to get a little technical, we'll use that term here in the slide for now. And if you take the relationship between the two, you say that, oh, the yield curve is flattening. We showed it on the next slide here in a second. But the moment you kind of have shorter term rates higher than longer term rates, some people take that as a perception that now the Fed is really meaning business, it's tightening. My own take is that you've got to look at financial conditions, not just at the yield curve. That's actually more relevant. And so here we have the same thing, except in the bottom panel, you see the difference between the two lined out. You have this is the difference between the two, and we're approaching zero. Now, historically, every recession has been preceded by a yield curve inversion. And I believe the next chart is on this again. Yes, and we are likely to get to a stage where we are inverting the yield curve at some point later this year, maybe early next year, unless long-term yields go up quite substantially. Now, I just indicated that every recession has been indicated by yield curve inversion, but it is a necessary and not sufficient condition, meaning there have been quote-unquote false signals. That means for an extended period after yield curve inversion, we have not had a recession. And some of the Fed presidents have indicated they are not going to vote for a rate hike if it does invert the yield curve, at least if they knowingly invert the yield curve with that. I'd like to remind folks that it is not the mandate of the Fed to avoid a yield curve inversion. It's just one of the symptoms that there's a reason historically why the Fed inverts the yield curve, why they keep pushing rates higher. And the reason is that inflationary pressures continue to rise. Remember, the mandate of the Fed is they have multifaceted, but the key mandate is to manage inflation. That inflation is about 2%. They call it a symmetrical target. And so they say price stability, they call it, but 2% inflation is what it means in practice. And so if odds are that inflation is going to increase further, well, they have to push the brakes. And the sooner they hike rates, the less likely it is they have to slam the brakes, right? And again, we are at record unemployment on the low end. We have a fiscal stimulus and we have accommodative policy. To me, the odds of having to go a little bit beyond just taking the foot off the accelerator, meaning having inversion, I think are very, very high. Now, the question then is, of course, how high you go. On top of that, and we'll discuss that here in a second, there are some special reasons why the long end of the yield curve may be low. And this chart here goes a little bit in more detail. I'll skip that. You can study that offline if you want to. But let's talk about the long end of the yield curve here a little bit. So we talked about the federal funds rate. We talked about the 2-year yield, and then put in context of the 10-year yield. And where should the 10-year yield be? And there's this perception that the 10-year yield is a proxy for the potential of the economy, right? And so it's one of the reasons why when the tax reform was being discussed, whenever it was more likely that tax reform would pass, longer-term yields would rise. So when you have an administration that reduces bureaucratic barriers, reduces red tape, or provides incentives for businesses to invest, that tends to raise longer-term yields, sell treasuries. It's one of the reasons why we have approached the 3% barrier, so to speak, again. Note, by the way, that this is a very long-term chart here. At the same time, when you have the fear of a trade war, if the market takes it seriously, well, if it's more than a short-term trade war, then that might impact the long-term growth potential. And there are many factors, obviously, that go way beyond a current tax package that affect the long-term growth potential. One of them is the aging of the society. An older society is less dynamic, grows less. That's why emerging markets, by the way, tend to have, it's one of the reasons, tend to have longer, higher long-term yields. But this particular chart here puts into context here where the long-term growth potential is with a 10-year yield. And now this is a focus on US rates, but it is very important to look at the international comparison. Here we look at the German 10-year yields, the bonds. In comparison, this chart, first of all, shows that the gray line here is US rates, and then here at 0.38, yes, that is the 10-year rate in Germany. In Germany, as of this chart on August 27, the 10-year yield in Germany is 0.38%. And so the gap, and the bottom panel here has the gap between the US and the German rates, is as high as this chart goes back to the early 90s, and that's very noteworthy. our senior economic advisor and former president of the St. Louis Federal Reserve, Bill Poole, has said in the past and believes that when central banks act in the markets, when they engage in QE, they're really using a straw zipping in the ocean. When they buy treasuries, the psychological impact is far greater than the actual impact. And the reason is they're substitutes for US treasuries. Clearly, by regulation, US regulation, US treasuries are safe, nothing else is. But for the typical investor, especially the institutional investors, a German bond or a Japanese government bond, they are proxies for one another. Now, clearly, they have slightly different risk profiles, but they should be tied at the hip somehow. And this means, this chart here shows that, well, this hip tying is quite loose. Now, another way to look at it, though, is that the quantitative easing that's happening still in the Eurozone, where it's supposed to be phased out by the end of the year, and to an extent also in Japan, is pulling down US yields. Now, if that is the case, how significant is a yield curve inversion? Meaning that US yields, if Germany didn't print money, would US yields be much higher? And that's a very fair question. Nobody really knows that. But that's why some people say, hey, quote unquote, this time is different. My own take is that, well, we can talk about yield curve inversion, all that fun stuff all the time. It's really the financial conditions that matter more. And the yield curve inversion is just one of the kind of the symptoms to look at. Now here we show the percent of global debt that's negative yielding. We still have 15% of global debt that's negative yielding to a significant extent. That's debt issued in the Eurozone. It's one of the data points to watch. It's something, obviously, that historically speaking is rather abnormal. We've gotten used to that. In the US, by the way, when we talk about taking rates lower in the next recession, most observers think we're only going to go to zero, that the US is not going to have negative rates. We'll cross that bridge when we get there, I suppose. There are many operational reasons why in the US it is kind of difficult to do, but hey, never say never. In the Eurozone, people also thought it would be highly unlikely, and it did happen after all. So looking at 10-year yields here, we've broken out to this two standard deviation band, and that's shown here. And so some people take that the historic bull market in bonds is over. Others aren't so sure about it and saying some other forces, we'll talk about demographics here in a second, will take over again. But it is certainly noteworthy that we have broken above that band. And let's keep in mind, well, I'll talk about that here when I talk about demographics here in a second. And Nick writes down here that 3.1% is to watch. Well, that's the recent high. I don't know whether you can see the mouse here. That's the recent high we had, and clearly, obviously, whenever you reach to a new high in a cycle, that's very noteworthy. But hey, we are above that. The shorter, by the way, you are on the yield curve, Fed funds rate, right? The more it is influenced by policymakers. The further you go out, the more it is the market driving these things, and there are lots of things influencing them. If nothing else, it's speculators influencing them. You have obviously institutional money and so forth influencing these rates, but you can, with derivatives, you can take positions on them. And one of the odd things that happen is that when, quote unquote, everybody thinks rates are going to go higher, well, guess what? Everybody takes a derivative position on, and I'm using that in quotes, everybody, on higher rates. And then when risk is, quote unquote, off, well, guess what? That, quote unquote, everybody is leveraged money. You have to take those positions down, and then whatever thought everybody was happening is going to be unwound. And so it's one of the key reasons you need to have a longer-term view on these things, because in the short term, these things get disrupted. And the further you're out on the yield curve, like with a 10-year, the more difficult it is to have a storyline. It's also a reason, by the way, you hear 10 different arguments as to why a rate is where it is. They're all kind of right at some point during the day, week, month, or year, because you can always fit a storyline to something. To the markets. Here, the same picture on the 30-year yield. Note that we haven't broken out yet. Now we're talking about demographics here. look at the timeline. We're going back to 1850, and we see the median age in the US in the black line, the median age here, and that axis is inverted. And the argument here is that as the median age is moving higher, that longer term rates are coming down. Now, and a good reason for that is that we have seen in Japan, with its massive debt load, that interest rates are very, very low. And there are different views as to how influential that is. And let's just take a step back. Any price is determined by supply and demand. And so on the demand side, a young growing population is one that's borrowing a lot of money. When you are in your late 20s, early 30s, you're taking out a loan for a house, you're building something. Whereas when you're old, you don't have as much demand for debt anymore because you're living off your savings. And that is one of the reasons why an aging society tends to have a downward pressure on longer term yields. Look at it from the previous perspective on the long-term growth potential in the US. Correlating that, or growth potential, correlating that with yields, well, in all the society is just not as dynamic. Now, a little bit of a grain of salt, life expectancy has changed, and 1850, you probably weren't as productive when you were 60 years old than you're today. So some of these things you need to take with a grain of salt. But the one thing that the demographic argument does not take into account is the supply side of things. And the example, the parallel drawn is that to Japan. And there is merit in that, and it's certainly a factor in that. But keep in mind, Japan is quote unquote perfect. And what I mean with that, it's certainly not perfect from a debt point of view, but the infrastructure is perfect in Japan. While the GDP growth isn't impressive, if you look at GDP per capita growth, that's actually pretty good in Japan. The Japanese, it is very difficult here to what is it that you need to invest in and so forth. The only quote-unquote supply side that comes in is from the government. The US is a far more dynamic society, and you can argue that maybe as the US is aging, it's going to be less dynamic. Maybe we shut off immigration and so forth. But the US, first of all, has much less of a demographic issue than much of the rest of the developed world. And importantly, we do have that thing called the military, where we're playing the global policeman. And to the extent that we'll do that, there's going to be plenty of opportunity to spend money. There is this thing called Social Security, where we, depending on the sort of path that we're taking, in my view, we have to change Social Security to make that somewhat sustainable. I'm not the only one thinking that. We do have currently a tax reform in place that has our budgets completely out of whack, and based on my analysis, if out of whack is a scientific term. And so I would not necessarily say that the demographic argument is the one and only thing here to consider. The one thing, by the way, that Japan and the US have in common, and why Japan, that's in favor of the Japanization argument, is that the debt the US has is almost exclusively denominated in US dollars. And so if you have an economy that is a Latin American economy or an emerging market economy that borrows a lot in US dollars, and they quote unquote spend too much money, have unsustainable debt, while the currency can plunge and interest, and then suddenly you have to service foreign debt, a foreign denominated debt. The US doesn't have that issue, it's issuing its own currency. And so that's playing in favor that, hey, the only thing the government does when it's aging is the government is stepping in where the consumer was supposed to be. Inflation, in my view, is a monetary phenomenon. It is not a demographic phenomenon. Demographics is a very important factor. And yes, all else equal, there will be some downward pressure on rates. But a lot depends on how this plays out in practice. And there, my view is that different countries have different philosophies to go about it. Just like the Europeans kind of go through this contraction where saying, hey, we'd rather strangle the growth and have political turmoil. Whereas in the US, I do think we're much more willing to use the printing press. So let's switch here. There's a chart on high yield credit, the spread between that and treasuries. This is a measure of financial conditions again. If that spread were to move higher, that means that financial conditions have deteriorated. That means the Fed needs to do less work or even reverse. But we had this spike here. Remember, in late 2015, early 2016, that was fracking related, stress in the oil sector. Many people, including us, thought that would spread. It did not. But right now, we don't have any issues there. Now, there is one area where there's a little bit of stress. That is the bottom end of the investment grade spectrum. So without getting too confusing here, there are treasuries, there are investment grade bonds, and then there's high yield or junk bonds. Well, there are shades of gray here. And at the bottom end of the investment grade, there has been some relative stress. And my view is that the key reason is that, well, the investment grade investor is a different investor from a junk investor. And the investment grade investor now gets a pretty decent yield buying the safe stuff, US treasuries. And so that's punishing the folks at the bottom end of the investment grade. The other reason is that that there are some warning signs that some of those investment grade folks might move over to the junk side. But the short of it is that, to me, there's a reason why the Fed will continue to hike, because there has been no tightening. They don't want much tightening, but they want to see that their policies will have an impact at some point. This one here just looks at this in more detail of different sectors, whether there's any particular sector that is suffering. There are 1,000 ways one can kind of dive a little bit deeper. Let me move on from here for now. This conclusion that you can read here is Nick's conclusion. Again, I encourage you to listen to his video or read the comments we have in more detail below. Download the PDF at merkinvestments.com/research. And make sure you're subscribed to this if you're not, if you're listening to this without having received it through our email. And my take is that we have very low unemployment. We have a fiscal stimulus. I think the trade fears are overblown. Not that they are not a serious concern, but I believe a lot of that is political showmanship, and they have real impact. Don't take me wrong on that. But as we've seen with the recent announcement with Mexico, we are ahead of the election. Our president wants to show that there is success. At the same time, he wants to be versus Mexico. He wants to be tough versus Canada. That's a lot of show. And clearly, if you have uncertainty, that's not so great for business. But still, net, the economic stimulus, in my view, is stronger. And so on the backdrop of all of this, we have an economic stimulus. We have accommodative rates. I think the odds are very high that we will reach the point where we cannot take more people out from the sidelines in the labor force, which means wage pressures are going to increase. And that will force the hands of the Fed, no matter what the shape of the yield curve is, and they'll have to continue hiking. From Jackson Hole, the recent meeting of the annual kind of retreat that the folks at the central bankers have, what came out is that Fed Chair Powell indicated, well, we don't really have a clue. He didn't use those words, but he says that there are reasons why we should move slower, there are reasons why we should move faster, and so as a result, we just stay the course. And they'll have to stay the course until the market tells them otherwise, which means they will continue hiking a quarter percent every other meeting as they currently do, and then take inventory. And they're not going to be dissuaded by a data point here and there. Remember, Powell is a lawyer. He doesn't have his own fundamental view as Bernanke or Yellen had on different slices. And so he's going to be driven by what the committees say. The committees, they're slow. So that means he's going to be steady the path, continue to hike, unless there's a very good reason not to. And in my view, the reasons to hike will increase rather than decrease. Now, obviously, if you are the quote-unquote market, you take the average of the views. And so some will say, hey, yeah, he's going to continue doing just what I said. And the other ones say he's going to do less for numerous reasons, which means on average, it's going to be somewhere in between. And so That's where there's an opportunity if your view differs from that from the market. And so that's it. This is ahead of the long Labor Day weekend. If you're listening to before that, have a wonderful long weekend. When that weekend is over, odds are that as market participants return, liquidity will also return to the market. The markets has fairly dry. Volumes have been low in the markets, and so there will be always some interesting things. So keep these longer-term perspectives in mind as we go through them. So thanks for listening. Subscribe to these things and to these research reports, and browse around the other reports if you haven't done that in a while. And looking forward to communicating with you in the near future. All the best.